I'm Aoifinn Devitt, CIO at Moneta, and in this Moneta moment we are going to speak about investing outside the US and how we should think about international exposure across an investment portfolio. 2021 has been a challenging year for investing outside the US. The US has been the engine of economic recovery, and markets such as developed markets as well as emerging markets have significantly lagged. Throughout the course of the last few years, the US dollar has remained strong, while emerging market currencies in particular have been weak. Interest rates have been low globally, but outside the US they've been lower still, and even with a negative yield in some cases. This, together with currency volatility, has raised the bar as to what makes a meaningful return when investing outside the US. The next two slides compare equity market performance across the US, developed markets outside the US, and emerging markets. The first chart shows the rolling 3-year return over a 20-year period. The US markets are indicated by the orange line, developed non-US markets are indicated by the green line, and emerging markets are indicated by the blue line. In this chart we can see that over the last decade, the US have dominated global markets in terms of performance. In fact, the gap between US market performance and emerging market performance has been the largest it has been since the 1930s. The next chart shows the total return over the same period. And we can see that when we look at total return, the total return for the emerging market index, indicated by the blue line, is still higher than that of developed markets and the US. This is attributable to strong outperformance of emerging markets for the first decade of this period, and perhaps also shows the tendency for markets to revert to the mean. The US dollar has been extremely strong over this period too, as the next chart shows. This chart shows the US dollar index for the course of 2021, and we can see that with the exception of a period of weakness from April to June, the dollar has been consistently strong since then. So this recent dollar strength of course means that any non-dollar exposure will have depreciated relative to dollar exposure over the recent period. So what are our key takeaways from this Moneta moment? We firmly believe that global diversification makes sense in portfolios over the long term, particularly where non-US exposure provides access to different sources of return than you would get in US markets. For example, the emerging middle class in developing markets. Certain areas such as infrastructure provide exposure to global airports and toll roads where it is not even possible to gain exposure in the US. We believe that the US dollar strength is unlikely to persist forever, and that currency exposure in a portfolio will serve as an additional diversifier. The underperformance of non-US markets relative to US markets has led to a valuation gap, and this differential, as well as the difference in dividend yield, may present interesting investment opportunities in 2022 and beyond. This is particularly the case when we see that over 2021, flows were strong into US markets, but less so into non-US markets and emerging markets in particular. Finally, we do believe it's time to reassess whether historic growth rates will persist in emerging markets, as these may well undermine the case for investing there historically. I'm Aoifinn Devitt. Thank you for listening to this Moneta moment.